Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And Ramsey, good morning.
Good morning.
Hey, and we have two terrific guests lined up for the show. Do you want to do the honors and introduce them?
I would be happy to do so. So today we are joined by two distinguished guests from the Alliance for Lifetime Income, and we'll call the Alliance like our brothers in arms. This is great that we have the whole all-star team together today to have this discussion. We're joined by Cyrus Bamji, who is the head of communications for the Alliance, as well as Colin Devine, who's one of the Alliance's key research fellows. And we're looking forward to having a great conversation today about, one, the goals of the Alliance, and two, some of the terrific research that comes out of there and it's been headed up by Colin and his colleagues. So with that, Cyrus, why don't we start with you? Tell us about the mission of the Alliance, how it got started, and how things have progressed since those early beginnings.
Sure, and thanks for having us both on the show over here. So the Alliance was created about 3 years ago. It's a nonprofit consumer education organization, and it has really one sole purpose, and that is to educate Americans about the importance of protected lifetime income from annuities, in the simplest way put. We have about 22 members who are some of the biggest annuity companies and asset management firms in the industry. And from the first day that we established the Alliance about 3 years ago, as I mentioned, we also established this really kind of bold vision for our member companies and for ourselves. And that is a country where no American has to face the prospect of running out of money in retirement. And we firmly believe in that and follow that kind of vision every day, actually. So 4 fundamental goals that the Alliance has. Number one, educating consumers on the various risks that they face in outliving their savings. Number two, shifting people's thinking and the whole retirement planning conversation that financial advisors have with their clients, from focusing solely on accumulating savings to protected income and planning for retirement income. And that's a fundamental shift that really needs to happen in the retirement planning industry overall, as you probably well know. Number three, and it's a really important one, demystifying and countering some of the misinformation about annuities out in the marketplace. For decades this stuff has been out there. People don't understand, too complex, too hard to understand, heard it's bad, high fees, all these different issues and questions. So we kind of counter some of that, both in the media and the industry broadly, with facts, simplicity, and then really importantly, and it sounds kind of pedantic as I like to call it, but really decomplexifying the language that we use to describe annuities. Because we in the industry always tend to levitate to both acronyms and some of the other very difficult things that people, certainly clients, can't understand. And finally, number 4, helping advisors understand if they're truly looking out for the best interests of their clients. If they truly are, then they should be considering including protected income from annuities in any truly diversified portfolio. So that's really the 4 kind of goals that the Alliance has. One final point I'll say. Last year we launched the Retirement Income Institute, which is comprised of some of the leading scholars in retirement and economic scholars in the U.S. It's headed up by a gentleman by the name of Jason Fitchner, who is a former acting deputy commissioner of the Social Security Administration, actually. He was also chief economist for retirement policy there. Long-standing leader in the industry. We set up this institute. People ask, well, just another retirement institute out there. We set it up to be a little unique, or definitely different and unique from all the other academic think tanks out there. And we do this by combining academia with business for the first time. And we're marrying scholarly research that's being done and has been done for decades, as we all know, by some great thinkers out there, with real-world data and the practical experience of the industry and the businesses out there that are working in this place to create some of this research that's really, I like to call it actionable. People, policymakers, the businesses themselves, consumers can actually take this information and do something with it versus sitting on a shelf as proposals and plans and so on and so forth. So that's long running diatribe over here about the Alliance, but that's what we do.
Thank you. So, Colin, tell us about some of the work you're doing as a research fellow.
Oh, Colin, you're on mute.
I think we've all done that. It's like you've got mail, now you're on mute. I apologize.
Exactly.
Anyway, so first off, in the interest of full disclosure, I actually own 8 variable annuities. I was a former Wall Street analyst before I met up with the Alliance. I covered these products for a long time, and I actually thought they offered tremendous value despite some of the confusion out there. And as Cyrus said, with life insurance, with annuities, everybody understands what life insurance is. Annuities are just the other side of the coin, right? And they might be better characterized as longevity insurance, right? And so, Ramsey, what I started to look at was what are some of the risks people face as they get older, right? And there's a couple. One, you don't know how long you're going to live, right? 2, you don't know how healthy you're going to be. And 3, you don't know what markets are going to do. And when I dial all those together, right, in a world where we don't have a defined benefit plan like our grandparents did, right, then the risk, and that we all face rising longevity, then the risk of running out of money, and as I say, it's your own health, almost becomes a near certainty for most people. Again, unless you're fortunate enough to be one of the few who has a defined benefit pension plan that's indexed. If you do, you're probably in great shape, but that's not very many of us.
So tell us a little bit about the work you've done to kind of scaffold those themes for people. So those are well-known risks, I should say, to those that have done the work. And so there's two things. One is to let consumers know that this risk is there, and 2, to help them understand the depth of it, and 3, to help them figure out how to address it. So what's some of the work you've done to accomplish that?
Sure. So what we did, right, we wanted, and we did this in conjunction with Milliman. So, it's actuarially based. Ken Mungan, the chairman of Milliman, worked on this paper with me. And what we tried to look at is what is that risk, right? Again, marrying in your actual, longevity, mortality. Okay. And the one thing that we did was a little different, right? Because there's lots of these projections out there and all these, you can go to all kinds of websites. That's all nice. We introduced one thing. We said, what happens if you have a 20% market correction in the first 10 years of retirement, right? A lot of advisors know how your portfolio is going to do in accumulation is based on those last 10 years. It's a double-edged sword. How you're going to do in retirement, a lot's going to depend on the first 10 years. So what we looked at is what if that happens, right? What do you think the risk of that is? Okay, yeah, I'd probably go 100%, but everybody's got their own view, especially after the last year. But we looked at 20% drop. What if it happens? Markets could come back randomly, right? The Milliman's got the big stochastic generator, but we just introduced that one thing. What does it mean? And what it means is actually pretty shocking, and the implications both for individuals, but I would even distinguish it, men versus women. Okay, on average, okay, gentlemen, you live to 65. We're all going to go another 19 years, right? And if I ask, the 4 people on this call, podcast, who can beat that average? Everybody's hand goes up too. Okay, so we all know we think we can beat the average. Okay, all right. And a woman's going to go 22 years. Okay, so let's take a simple, very conservative investment portfolio, right? The 4% withdrawal rate. rule, right? Which, by the way, came from the 90s when rates are about 500 points higher than they are today, right? It's like retirement, the idea of 65 came from the 30s when the average male lived to be 62, not 79, okay? But we looked at that. If you took a 60-40 mix, okay, again, I think I'll go very conservative, a 4% withdrawal rate, if you get that 20% market correction in those first 10 years, what does it mean? What it means, tell you what, there's an 11% chance, gents, you're going to be out of money by year 19. So the average, and again, all three of you nodded your head, you can beat the average, okay? That's 11% chance. But for the ladies, going the extra 3 years, that risk doubles to almost 20%.
Wow.
Okay.
Interesting.
And think about that. That risk for a woman then of running out of income in retirement, and I don't think a lot of advisors thought about this, is really double what it is for a man. Right? And I don't know about you. I always think of my mom as a proxy for everything I do. Her risk tolerance, I think, basically reflects everything. There's no chance she's taking a 20% probably, risk of running out of money. I'm not sure she'd take 2. I know 20. Not a chance.
Right.
That's what we look for.
Yeah, so Colin, first off, my wife is planning for an early demise on my part. All the life insurance is all in order. Ramsey, we've got all the... She's not leaving anything to chance here. So Colin, it fascinating. I mean, when you actually put numbers to that and think of, the risk confronted by a woman versus a man, I don't think people have really... That hasn't resonated. You also made a real interesting comment about the time lag, right? It's almost like we're sending radio signals. Our retirement planning is based on radio signals sent from Alpha Centauri, and we're, take out 4%. Oh, whoops, no. Bad decision. Think kind of going forward. Interest rates have come way, as you know, they've crashed. They've started to come up. Good news is they've come up. The bad news from what I've seen is, the spreads have actually compressed. If you try to, take any kind of, credit risk, okay, wow. So I put 40% in bonds. What are those things going to yield? 60% in the market. Well, all the growth seems to be coming from the tech sector. For everything else, it's not. How does this factor into this, this whole crazy market from a carrier perspective? What product do we build, right, given this new crazy market that we're in?
Well, it's where annuities come in, because the part that gets lost with annuities, right, beyond the returns, is the benefit of mortality pooling, right? By the way, that's the same thing, we're all buying on life insurance, right? Most of us aren't going to die young, right? So for most of us, life insurance is a really bad deal. Except if it's not, and you do die young, then it's a great deal and it protects your family, okay? This is the other side of that. Right? This is the other side of that. And that's what's, beyond the returns, what they can get in the bond market, it's a benefit of mortality pooling. It's what if I do live long, right? Which again, not only that, of course, when you think about the value of annuities and lifetime income, protect the lifetime income, it's how healthy are you going to be? It's something else. I don't want to be Dr. Doom here, but the sad part is that about half of Americans, age 65, are going to face some form, which again, probably intuitively makes sense, sort of major health impairment that will trigger a long-term care need over the remainder of their life, right? What's the leading cause of personal bankruptcies? Medical, right? So they're running out of money. So you can even think you have enough until you hit that healthcare blip. And again, I only gave you average numbers, okay? The standard deviation on that's 10 years, okay? So, what if we went 25 years? The 60-40, again, that conservative, there's about a 30% chance of running out of money. By the way, if we went to 80-20, let's jack up the equities because we don't like fixed income. It doesn't change it very much. It's not going to help you. Right? So how do I beat that? I beat it with mortality pooling.
So you brought up a really good point there that it's not just about the average, it's about the dispersion or variability around that average, and that makes a very big difference, right? So if everybody lived to the exact average, it would be a much different problem than with the same average, but this much greater dispersion, right? So let's build on that a little bit, because that's a very, very important point. So the average person might do well, but if like half the people lose out and half the people are better off and half the people are worse off, that's not a good societal outcome. So let's dig into that a little bit.
Sure. One thing that I did give you with those numbers is how fast might you run out of money? Okay. So we ran thousands of scenarios. You know, this Milliman's got their supercomputer and off they went.
Yeah.
That 60-40, the earliest was 12 years. Okay, from 65, I make that by my math 77. Okay, that does not compute, right? Right, and again, that if you knew when you were going to die, okay, retirement income planning would be a heck of a lot easier, right? The problem is you don't, right? And you were all watching longevity rise. We all think that's a good thing. It's great if you're healthy. So how do I insure that tail risk, right? And annuities, so if you think of it simply as longevity insurance, are the way to do that. Now, I want to jump on one thing. Cyrus was absolutely right. Like, too complex, too many terms, different terms, the same term means different things at different companies. Shame on all the carriers, right? We love the members, but one of the reasons the Alliance is here is to try to take the jargon out of it and get it back to what it really is. It's life insurance. It's just the other side of it. It's to insure you against living a long time, because to your point, Ramsey, you don't know, right? Can you walk into Hallmark and buy a birthday card for age 100? Absolutely. I used to use it as a prop in all my speeches, right? You couldn't do that 10 years ago.
Yeah.
Right?
Hey, one other stat just to add to what Colin's taking. People don't, they know people are living longer, right? Americans in general, we just know we're living longer. We saw how long our parents lived, grandparents lived, that kind of stuff. But here are the actual numbers. So in 1964, when the first boomer actually turned retirement age, the average age of an American, average time at that time, was 70. Today, it's 78 for a man, and it's over 80 for a woman in just this time period. So, going back to what Colin was just saying over here, running out of money by age 77, you are not beating the odds with that. It just doesn't work. And as we were just talking about, how many centenarians do we know? I mean, we read the news and watch the news every day, and there's another centenarian getting congratulated over here. So don't be surprised if we live 20, 30, 40 years in retirement. I mean, that's the bottom line.
We've had Blair Baldwin on, who launched Age Up as part of Mass Mutual, and interested not to get your take on the product, but sort of the concept, which I find fascinating. Which is, Colin, to your point, it's and starts like life insurance. Do you think we'll see more products like that are almost like catastrophic longevity insurance, where we've created value? It's not a tontine, but it's kind of getting there. Is that the future? Colin. Oh, Cyrus. I mean, what's your take on that?
I think that we've been watching this industry for a while, and our members in terms of what they're doing. There is a lot of product innovation going on right now in the industry. A lot of it's been triggered by, obviously, as we know, low interest rates. Changing the equation here and there, but there are new products that are very innovative in how they're structured and so on and so forth. Part of me gets a little wary of that, because once again, you're changing products like that, and the complexity often goes up in it. But there is a lot of product innovation going on, and you mentioned tontines that have been that's been talked about for a long time, as you well know. They may come into fruition. There hasn't been a lot of pickup yet in the actual commercial market or in the individual market. I will say this final thought. There's a lot of innovation going on in the 401k space. And as we know, with the Secure Act being passed 2 years ago now, a year and a half ago, a lot of companies are starting to innovate and create products that annuities, basically, that can fit within those 401k plans, whether it's through a target date fund or other ways. So there is a lot of that going on, no question about that, which is great for the consumer ultimately, because that's what's driving this change, right?
Yeah. Colin, what's your take on sort of the extreme? Let's say it's not a taunting, but it's like, oh, lost Colin. We're having a few.
So I've got a question. I got a question for Cyrus in the interim.
Yeah.
So Cyrus, you were very clear about this need to. You and Colin very clear about this need to sort of reframe the conversation, the verbiage, nomenclature. Tell us about that. So when one goes to your website, retireyourrisk.com, I think the last time I looked, I don't think I saw the word annuity anywhere. There's protected income, there's retire your risk. So tell us about how you took that journey to change the language around this class.
Well, I don't know when was the last time you looked, but the actual website now is protectedincome.org.
Oh, okay.
Retire Your Risk was one of our early campaigns. We did that a couple of years ago when we first started, but the website is protectedincome.org.
Okay.
And it is now filled with the word annuity across it.
Oh, it is.
I get the thing that we like to, and what we've done over here, and our research is showing it, which is great. Consumers are starting to understand how annuities fit into their thing. We've been tracking this now for 3 years in terms of their understanding of it. The whole term protected income really comes into, we describe it as a category of products, right? There are 3 ways that you can get protected income in the U.S. today. Social Security, which is a type of annuity, but that's protected income. Number 2, a pension, as Colin was mentioning, that's a type of annuity as well, and that's protected income. The only other way that you can get it is an annuity itself. And so when we talk about protected income, we kind of describe it as almost like an asset class and a category of products within which, for retirement planning, when you're sitting down as a financial advisor looking at this, that category should be taken into consideration. What's in it? Social Security? Do you have a pension? Unlikely these days. Do you have an annuity? No. That's the gap that we're trying to fill over there in that protected income gap. So that's kind of it.
Yeah, well, and Cyrus, of course, the first thing that comes to people's minds when they start thinking about retirement is not annuity. It's a lot of other topics. So it's interesting, since we talked a couple of days ago, just as prep for our call. You talked about retirement stats. Now, happenstance is I got like 3 or 4 inquiries from different reporters, all writing stories about early retirement. Should you take early? What if you're forced into retirement? What if you take get a package? Should you take it or not? Tell us just what's going on now. What's the state of retirement?
It's a great question and a great point. So, what we've all been going through for the past year and a half now, which is the pandemic, has really triggered this, I would say, a precipitous change in a lot of things in our lives, of course, but it's also changed retirement. So last year, there were about 4 million people that retired either early and or were forced to retire thanks to the pandemic. That's about 2 million more on the average than in past years, baby boomers, basically. And it is early retirement for a lot of them. So what happens? They're out on the street, basically. They don't have a job. And many of them are saying, I give up, I'm ready to retire. But they're retiring at ages 62, 63, 64, and in their early 60s. Unfortunately, many of them are going to start drawing down on Social Security. Well, how does that hurt them? Well, as my friend Jason Fitchner, who was at the Social Security Administration, would say, taking Social Security at 62, yes, you're eligible, yes, it's great. But the money that you're leaving on the table with Social Security, by taking it at 62 versus full eligibility age, which 67, 70, depending on which year you were born in, is huge. I ran the numbers for myself, and it's the difference between $2,000 a month and $4,000 a month. So people, going back to your initial question, last year was really, really hard on baby boomers in general. And the statistics keep pouring out on this, in terms of what's out there. One final thought that I'll leave you, or one final point on this. We saw some research a few years ago, about 3 years ago, on a longitudinal study on bankruptcy in America. And the biggest growth in personal bankruptcies was in folks 55 plus in the U.S. Well, if there's a canary in the coal mine out there, to tell you that we're heading towards some type of a retirement income crisis, to me, that's one of the first things to tell, to point that out, that you're going to see a lot of people basically going bankrupt as they age over here. A lot of it driven by healthcare costs, because they're as we age, we get those costs go up. But it should tell us that we need to do something today to change that equation, and it goes back to part of what our education campaign's about.
So how much of this comes from the industry? How much of it comes from the government? How do we get there? I think all four of us want the same thing, right?
Yeah.
So who are the players in this play we're trying to put together? Because it can't just be us. So we need to get more people on board. Who do you think of the first and most important target audiences beyond the consumer, obviously?
Well, yeah, as you said, the consumer first, no question about that. We just have to get people, Americans, aware of what retirement planning really needs to be. And that is that whole get out of the mindset that, I've saved $500,000, $1 million, $2 million, whatever it may be, in this big nut over the past 40 years of working. And I feel pretty good. People have told me I need more than $1 million nowadays, that kind of thing. Thinking about that lump sum and really start thinking about what the heck are going to be my costs as I retire. Once that paycheck stops coming, what's going to be my monthly cost or annual cost? And not just for the first year, 10 years, but 20 years, 30 years, potentially, of it. So no question about that. But another point to make over here is policymakers, no question about it. The regulatory scheme really needs to change and is changing. As we know, the Secure Act was passed a year and a half ago, was the first piece of legislation, I think, in 20 odd years that focused on retirement, which is a big deal. It did open up opportunities for annuities to be used within probably the biggest savings vehicles that most Americans have these days, which are 401ks, and making employers aware of annuities is a big push that we have over here. So there is Secure 2.0 happening right now, and it's on the Hill as well to advance even more on that. So I think policymakers are finally starting to get wary and starting to move on this. And then the industry itself. And we see this, as I was just saying, about the innovation happening with annuities in the marketplace, both in the delivery of annuities and how they're actually provided to a client, whether it's through financial professionals, through technology platforms that large broker-dealers and financial advisors have. That's also changing the equation. So, long story short, I think it needs to be a pull for just about everyone involved in retirement planning. And of course, ultimately, financial advisors themselves. They've got to change their mindset on how they're doing retirement planning for their clients.
Interesting. And Colin, just from a carrier's side, so if I'm running annuity product development or annuity management for a carrier, what are the what's the most important question or a couple of questions I should be trying to answer with my team over the next year as we think about what we should be doing?
I think it's creating products that transition with people, right? If you think about living benefits with variable annuities, right? They were launched as a savings product. Why did I buy mine? Because I'm going to use them as an income product, right? To transition with you. And I think that's what we need to focus on more as an industry. It's not just, getting to retirement. It's getting you through retirement. Two things, when you think about your IRA, I measure the performance of mine by how much income it buys, right? I don't want to die with that. Otherwise, I'm just making very nice, tax contribution to the U.S. Treasury, which we're all patriotic, so that's great. But, that's the asset you want to draw down over the remainder of your life, right? So it's how much income it will bring, and that's gone down from probably $70,000 if you had $1 million, 5 years ago, to about 15 change today. The other thing Cyrus mentioned, in terms of legislative change, one that I thought was very significant is when the IRS will now let you put a deferred income annuity right inside your IRA, and it doesn't count against your required minimum distributions, right? The DIA, right, is purely longevity insurance, right? It's a way to take your IRA, insure your tail risk, right? Because you don't know how long you're going to live, right? And do it in a very straightforward, clean, easy fashion, right? You can have a kick in at 80, 85 that can, pay extra healthcare costs because you're probably going to have that. But that, to me, is for most advisors the place to start, because now I can't outlive the IRA, right? Now it's like a pension. I can't outlive it.
So is that one of the first? So that's a QLAC, right? Qualified Longevity Annuity Contract.
Yeah.
So, are those being talked about enough? I think there was a while they were being talked about a lot. Things seem like they're quieter. So it sounds like they need to be talked about more. And it seems like a natural fit is in the advisor conversation. How do we get there? Yeah. Or are you having those? Are you finding receptivity when you talk to advisors about it? Is perhaps the better way for me to put it.
Yeah, it comes down to education, right? So many advisors, annuities out, they're high fee, they're this or that. Well, if they were high, if like variable annuities were so high fee, a lot of carriers would still be writing them that aren't writing them anymore. Right?
Well put.
I thought they were a great deal. That's why I bought them, right? So I love them. But it's getting advisors just to look at it and, again, to understand that risk. And like I said, if you add that one thing, what if a 20% market correction happened in your first 10 years? Rerun the numbers then. Yeah. Right? Now if it happens in year 40, you're good. You're at 30, you'll probably be okay. Hey, if you live so long. But it's in that first 10 years. And if I would think the pandemic, the last year, has shown us all anything. Right? That can happen fast. But if again, go back, you guys are in this. The 20% market correction happens all the time every 10 years. Right? The financial crisis was before that, right? The .com before that.
Yeah.
And again, there's so many boomers, as Cyrus said, in 2024, right? The peak hit retirement. What if you have that market correction in the first 10 years?
Yep.
My numbers tight, they're going to run out of money.
I read a statistic from research in 2018, so 10 years after the 2008 crash, right? That actually showed that 30% of retirees who had lost 40, 50%, whatever it was in their portfolios during that time, 30% had still not regained and gotten whole 10 years later. That just, blew me away, absolutely blew me away, to think about that it took 10 years just to get back to what they had back in 2008 in terms of their nut. And they're spending it, right? I mean, they're drawing down on it during during those past 10 years period. So, all of these are great red flags to use, and we use them, in terms of educating folks about these type of things.
Yeah. I mean, you'll hear people go, take less, right? When the market's down. Okay. You can't afford to take less because all your other assets are down, right?
And your expenses aren't going away.
Right.
Yeah, your expenses haven't changed. So that's, if you want to eliminate that, so that's what the Alliance is there to do. It's just to sort of educate. And again, to think about the difference. You wouldn't think 3 years could make such a big difference, right? 19 to 22.
Well,
that doubles your risk.
And it's so complicated. I mean, I don't want to open it. This is a whole other topic, which I think we got to have the 4% rule. Oh, I'll just follow the 4% rule. Well, is that so? When I retire, I figure out 4% of my assets and I pull those out continually for the rest of the time, or do I take 4% out of each year? Right.
Or each month.
Right.
Yeah. Exactly.
So, well, Paul, drop it to 3. Okay, take it down to 3. We'll make 3 is the new 4, right? But even then, a woman's going to face about an 8% chance of running out of money if you have that market correction. Yep. Again, my mom's not taking that, right? And again, it's pretty binary. Like, you're out, right? This is not going to work. If I can eliminate that risk at a reasonable cost in a simple, transparent way.
Yeah.
It's just like buying life insurance. That's all it is.
Yeah.
Nothing more complicated than that.
There's, just to pick up on what Colin's saying here, kind of a final point on this. People don't realize that there's not just covering your risk, but there's opportunity when you include an annuity in your portfolio. And that opportunity is this. If you use, which most people do, and we talk about this, if you use that annuity and the income from that annuity to pay for or help cover your essential expenses, your basic expenses, because at the end of the day, that's really what people, retirees care about. Can I cover my mortgage or my rent that I'm paying over here? Can I cover my groceries and my gym membership over here? Whatever that number is on a monthly basis, can I cover that with something and know that that's taken care of for the rest of my life? If they know that, and if a retirement, financial professional and financial advisor thinks about it that way and has an annuity to cover that, the numbers show it out that the rest of the portfolio can be far more aggressively invested over here for growth. And you have the rest of your money over here to do the things that you want to do, whether it's traveling or whatever else it may be. That's a huge, our research just shows that when people do have annuities and it's covering most of their essential expenses, their ability to live the life that they want is amazing. It's amazing to see, and the responses show that. So,
Cyrus, what I would add to that, guys, is everybody puts fixed income in your retirement account, right?
Right.
Okay. The annuity is fixed. That's the fixed income piece with the benefit of mortality pooling, right? You've got the option on the mortality pooling. Think of that as your fixed income. That's what I do, and then I can take the equity risk with the rest of my assets, and specifically the non-qualified assets, right? I'm turning that IRA, that's the fixed income piece for me. As I say, I look at the annuity as fixed income with the mortality pooling option.
I love that. Fixed index or fixed annuity, or your annuity is your fixed income.
Fixed income.
Yeah.
Yeah.
With mortality.
The only difference is that out of all the fixed income products out there, this one's guaranteed.
Yes.
Yeah.
Because even with fixed income products, we know how that goes.
So I can't outlive it.
Yeah.
I can't outlive it.
Yeah.
Well, hey, this is terrific. So let me just ask you, kind of what's next? Cyrus, for your organization, and Colin, love to know, what are the next topics on the horizon that are fascinating? So Cyrus, tell us what's next for the Alliance.
Well, there's a lot, and you'll be seeing a lot of this year in terms of coming out, including, one of the big things we did 2 years ago was sponsoring the Rolling Stones tour. The exclusive sponsor, actually the sole sponsor for the Rolling Stones tour, and people say, "Holy cow! What's a financial, nonprofit education organization doing that?" Well, it's to be able to reach the population that we're trying to reach, right? The majority of folks that go to the Stones, like it or not, are older, and it's a perfect demographic for us. So we did the tour back in 2019. Last year we were again a sponsor. As we know, everything shut down, so we're hoping and we're expecting them to come back this fall, hopefully, to the U.S., and we'll still be the sole sponsor of that. So that's a big thing. One other point I would love to make, just to pick up on going back to Colin's research on the 4% rule. One of the things that we did with Milliman, which is, by the way, a member of the Alliance, is develop a really cool, very simple tool for consumers called the RISE score. The Retirement Income Security score. And it's on the website, ourprotectedincome.org website. You can go to it, and it's for consumers. It's also for financial professionals, but it's a simple illustration tool to show you plug in some demographic information that you have. All of it's anonymous. You don't need to put names in, that kind of stuff. You go through it, talk about what savings you have, if you have a pension, if you have an annuity, whatever it may be, and out comes what we like to call, it's like a credit score for your retirement risk. And it gives you a credit score, basically, or a RISE score in this case, that tells you what the risk is, what your chances are of running out of money in retirement. So it's really a very, very powerful tool. We've had, thousands of people taking this on a regular basis, and they run little scenarios all the time. But the most important thing is it makes them aware that there's going to be this gap going back to it, in terms of their income. A lot of people find that there isn't, which is great. But if you know there's a gap, go talk to your financial professional, take that RISE score with you and say, hey, this is a simple illustration that I just did through this organization over here, but what's the reality of it? Can you map this out for me? And it's proven to be really, really effective for us.
So yeah,
Colin's taking it. Colin's in good shape. He's got a number of annuities, as we know.
So very big fan of the RISE score here. We use it on the Alex.FYI site as well, and it's a great wake up call, right? It doesn't necessarily tell you what the answer is, but it's a wake up call. And I've had financial professionals take it, and I had one financial professional took it, and he said it was jarring to him, right? It was jarring, and he reran more and more scenarios and realized he had some work to do on his own portfolio. It is a fantastic conversation starter and a terrific collaboration with Milliman. So fantastic.
Exactly. Thanks.
Yeah, and Colin, what's next?
Sure. So we're going to do a couple of things. We're going to take the study we did last year, the one I referenced, looking at the 4% and putting in that 20% market drop. A lot of people ask, what if I took 3? Okay, so to sort of show everybody what that would mean. The other one is, what if markets stayed down for a full year, right? So we're going to kind of throw that into, and again, it's retirement income planning is hard, right? It's damn hard, right? And to show you some of the risks you face, right? And then how can I, reduce that risk? So we're going to look at that. And where if you want to get your client's income back up, maybe take it to 2. Most clients aren't going to go with that. So, can I use an annuity to get it back to 4 to 5? And the other thing we're going to look at is some of the innovation on products, right? Some of the riders, features that you can get with these products in case your life changes, right? Some of these accelerated death could be accelerated death benefit, accelerated chronic illness / long-term care type rider, because that's the thing, right? Retirement for our grandparents, our great-grandparents, was probably 5 years. We're facing 20, 25, 30 years. A lot. The one thing we can all guarantee, probably, Grant, a lot's going to change in 30 years. Mm-hmm. Yeah. I think the last year told us that. A lot's going to change. And to look at products that can kind of age with you, where the advisor can still work with the client as their life changes. So we're going to focus on innovation as well.
Excellent. Ramsey, what do you think? Final thoughts, questions?
So I just want to thank you, you two individually, and congratulate you on the work that you're doing with the Alliance for Lifetime Income. It's very important, right? And it's very important that the whole industry works together on this common message instead of competing, which is sort of was the natural order of things before, right? So keep doing the great work. We'd love to have you guys back on the show, or other research fellows. I mean, we'd love to continue our relationship with you on a going forward basis, and we're looking forward to doing